Welcome to Revere Asset Management's Your Money with Danny Stewart
The market will always overshoot to the downside and to the upside.
and Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
Are you Wall Street's widget? Let me repeat that. Are you Wall Street's widget? Their alternative investment, the investment asset, the diversifier for their pie charts are us. So you guys have always thought about that. I want you guys to think outside the box here, folks. I'm going to try to draw you in. So think about it. You always think of the ETF or the mutual fund where they buy a bunch of stocks and bonds and then people go put money in the mutual funds and invest and you get a pro rata share of that, right? Well, in this situation, they're doing these private equity ETFs, and I know I talked about this. They're doing these ETFs where they're putting in illiquid private equity into these liquid things, and they're going to sell them to you, the retail investor. And what could go wrong there? And that's why I'm telling you, if you're getting your investment advice from a broker, you're getting it from the sell side. Your advice is compromised. It may not be advice at all. It may be propaganda sales literature disguised as advice wrapped in just enough compliance to pass the smell test. So they're actually against you. You're the cattle, and they're delivering you to the. But look, these big investment banks, they need to raise money for the municipalities, the countries, the companies. They need to spread it out all over the world. They need to diversify for their clients. See, you're not the client. You think you're the client. You're the cattle. The client is these big corporations, these companies, these countries. So they need to spread it out and raise money for everybody. That's why that diversification story is out there, so that they can spread the wealth to their clients. They can spread your money to their clients instead of putting your money in the best areas and avoiding the weakest areas. So in any event, when these things start to go south, I mean, who's monitoring these? So let's think about this. On a regular IPO, you get a stock, right? Well, first it starts out, you get an angel investor, they come in, they put in money, and it gets to the point where they need more money and it's growing, it's turning into a real company and getting bigger. So then they get mezzanine financing, bridge financing, all of a sudden you get all these people involved, and then they finally want to take it public. When they take it public, they offer a red herring, and they show you all the stuff, and they just got to give you full disclosure so you can determine what's good or bad, right? And then you can decide whether you want to participate in that IPO. But once it goes in the market, it's just going through supply and demand. But at least there's a lot of disclosure. Now, in this situation, it's not each individual security that's getting looked at by you, the investor, to decide whether you want to do the IPO or not. The sell side over here now, all these people that have raised this money and got these deals, and now they're looking for a liquidity event. They need to cash out. They're going to put these deals in these ETFs, in these private equity ETFs, and they're going to load them in there. There's going to be good ones and bad ones. It's all going to be kind of mixed up in there. But when it starts getting in trouble, that's when they're going to stuff it. So let me ask you, do they go buy the stocks and bonds or even private equity, whatever they're going to put in there first, and then they raise the money? Or are you putting in the money in the ETF and then they go buy the assets and spread the money around? Anyway, I'm just wondering, because I'm wondering whether they're priming the pump and greasing you up for FOMO so that you can get this private equity that only these wealthy people get. Or is it really the sell side unloading this illiquid stuff into liquid ETFs so that the big boys can actually create a liquidity event to get out? That's a question. Okay, so here in the mailbag, here's a couple things. Apollo has created a lineup of non-traded business development companies which invest in private company debt and non-traded REITs for wealthy clients. Now they're quickly becoming mainstream. Financial advisors will sell alternative investments as non-correlated assets and use them in client portfolios to diversify risk, not Revere. Here's the problem, folks. Those private deals actually, when it hits the fan, become highly correlated, but also illiquid. So now you can't even get out. So anyway, my main point, we're in a late stage, probably in a late stage bull market. Maybe not. It may keep going higher. But we're in a late stage bull market characterized by late record IPOs. We're having record IPOs right now. And you're also starting to push alternative assets to mainstream investors. Remember, in 2007, they started doing all these derivative Ginnie Mae and Freddie Mac high interest derivatives, right? They're starting to do the same thing again. So the market feels high to me. I'm scared, but the market wants to go higher. It keeps going up. So the main point is, what is your sell discipline? What's your parachute? Okay, you don't want to give up all these hard-earned gains. We've worked really hard the last couple of years to get these gains. So how are you going to do that? That is the question, because that's a really important question, and they're going to try to give you a diversified pie charts or us portfolio. Folks, when it goes down, all the correlations grow together and it all goes down together. You don't want diversification. You want just cash or maybe treasuries and gold, right? But when it goes up, you want just enough diversification so one Enron line on the books doesn't kill you. That's it. But you don't want a pie charts buy and hold through thick and thin. Otherwise, you're going to have to go through a 30, 35% drawdown every 5 years or so. Just go back and look at history, okay? So in any event, very quickly, I'm going to do this one mailbag, and then we're going to go to the team. This is 131 JH. NVIDIA, and I may have done this last week. I don't remember. It came in the same day we did the show, but just in case. NVIDIA appears to be finding the support at the 240 a week. I recall Alex saying that the major stock finding support at key levels is good opportunity. Does the rest of the team have any views on NVIDIA? We are constantly monitoring all the leading stocks for opportunities. It's not only whether NVIDIA finds support here, but it is that the best setup, or are there better alternatives? And how much exposure do we want in that particular sector? And would NVIDIA add too much? But yes, we're following closely and still own NVIDIA for some taxable accounts that we hedge due to very large gains. We've already done a podcast early, so go watch the show. Last week we discussed NVIDIA. So in any event, so now with that, I want to go to the team and the team that Don built, and I'm going to show you, we're going to pull back the curtain. We're going to show you how we manage money, what we do, how we make decisions, because we actually have buy and sell rules. We are not going to ride the market down. We have never had a bear market at Revere, and we don't intend to. So with that, I give you Don.
Thanks, Dan. There's two themes that we're going to dwell on today during this podcast. The first one is level by level. And what this is at its core, trend following. Trend following is keeping track of the indexes and where they are relative to recent highs, recent lows, and moving averages that we use to track the short-term, medium-term, and long-term trend. Level by level right now means it's best to look at it on a 60-minute chart here. And basically, we're in a 15-day trading range that started on the 17th of January. And it's basically from 59.78 or so to 61.21. That encompasses most of it. There were some heads poked above and below, but they didn't stick for any period of time. And as long as we hold this range, we're going to continue to be bullish from an index perspective. The second theme to stress is there are no hold forever stocks. And we're going to talk when the guys do their individual segments about how destroyed some of these names can actually get if you continue to like the story after the price action tells you that you should no longer own the stock. And it's going to be chock full of examples that you can look at. So the combination of those two factors, one, level by level on the indexes, and two, there are no hold forever stocks. This is what's going to allow us to keep on to hold the majority of the extremely strong gains that we've made since the November 2nd, 2023 follow-through day kicked off this big bull run. There have been several pullbacks during this March, April 2024, July, August, again, late August, September, and December into early January of this year. But every time they've recovered, every time they start breaking certain levels, we get more defensive. Every time they reclaim those levels or key moving averages, we get more offensive. As long as leading stocks continue to act well, and they really have been, we're going to continue to be invested in those as well as the indexes to smooth the equity curve. And that's really a summary of where we are right now. If you look at this daily chart here, there's a couple of big points that we want to make note of. The 13th of January was the DeepSeek Deep Red Day. That was over the weekend. Some news came out. A Chinese open source AI LLM claiming it was developed for significantly less than any of the big boys models have been developed. Since then, that's been mostly debunked. And then last Thursday and last Friday, negative reversals on tariff news, and a big gap down on Monday from Trump saying over the weekend, in fact, signing an executive order to introduce 25% tariffs on Mexico and Canada because they would not commit to taking action to control the flow of fentanyl across the borders. Monday, by end of day Monday and after market Monday, they had agreed to increase their troop access at the border. The tariffs were taken off. And now today we had another, if you look at a 5-minute chart, we had another move down when Trump said his next move is reciprocal tariffs on Europe and China that are overcharging us for certain products. So these tariff headlines are going to be a constant over the next 4 years. It's a way to there is no such thing as free trade if you're taking in way more goods than we're sending out, and they're charging tariffs on the goods that we're sending out. There's nothing free about that. So he's trying to level the playing field. It's caused a lot of volatility in the markets, but we haven't broke levels. So what we're doing is taking position sizes that it's more of a buy on weakness, sell on strength, with the exception of big gaps up on earnings that have monster volume. Those are an exception to that. You want to pay attention to those. And we had a couple more of those today, in addition to one that we got into earlier this week. But it's level by level on the indexes, and on a stock by stock basis. There are no hold forever stocks. How long? People say, what's your typical holding period? Our answer is as long as it acts well. The first stop is usually around the 8-day moving average. The second one is the 20-day. The third one is the 50-day. If we have huge taxable gains, we'll give it down to the 20-week or the 100-day, or start hedging. But that's the process. William O'Neill famously said all stocks are bad unless they're going up, and we agree with that 100%. That goes for indexes and sector ETFs as well, which we take advantage of when we need to.
Right.
That's it from a summary standpoint. Dan, you got any questions on that?
That was a very good summary, Don. That was a very good summary. So what is the approximate beta? What is the beta? Not approximate, you know pretty well. What's the beta of the portfolio?
We are about 80% invested in Grotection, and the adjusted beta is about 1.4.
Okay.
So a full portfolio of 100%, the S&P 500 is a 1.0. So we're 40% more aggressive than the S&P 500 right now.
With 20% cash. So I want folks to hear that.
With 20% cash, right.
Because your cash is not, it's a variable with how risky the portfolio is, but it's not the only variable by a long shot. In fact, there's more important variables than your cash position, just so you know. All right, go ahead.
That's it. I think we'll go on to the individual segments now, and let's start with Ted.
Yep. So continue the theme of Don saying that these growth stocks cannot be held forever. I'm going to call my segment the best winners often become the best losers, or the biggest losers and best shorts as well. So I want to start off with a market leader of this last bull market, ELF. And Don, can you pull up a weekly chart so we can visualize the stage analysis? And actually, before I get started, I just want to quickly review stage analysis, nothing too in-depth. We like to key in on the 30-week moving average, which is Don's magenta line, and the 40-week moving average, the black line. And pretty much a simple mental razor for us is above a rising 30 and 40 week, that's where we want to be long, and below a declining 30 and 40 week, either want to step aside completely, or if you are able to short, that's when you want to short. And you can see the price action play out perfectly. This last pretty much 2 years, it was in an uptrend. You can see the rising 30 and 40 week. Then it started seeing a little bit of choppy action, some distribution in that June, I believe, 2024 area. It started to form a deeper cup, which retraced all the way back to the 40 week. It built the right side, but then it had a failed breakout. This caused ELF to drop below the 40 week. And oftentimes you can tell a stock might be topping out when the rising moving averages, the 30 and 40 week, catch up to price and start flattening. So Don, can you highlight the previous uptrend? You can see price was well above the rising 30 and 40 week.
Yeah.
As you can see, as the move matures, these moving averages start catching up to price. And even though it looked like ELF at one point, early 2024, if I see the screen properly, it looked like it was going to fall into a downtrend, but it didn't. It ended up making a final move, but then the moving averages caught up, flattened out, and now we've been in a stage 4 decline for over 4 to 6 months now.
But
and
folks, hang
from
on,
high to
Ted,
lows.
Ted, hang on. So folks, even if you got out, so if you look at the moving averages, see how they're kind of stacked together and they kind of group together on the far right of the screen where it really breaks down those last 3 days. If you just sold when they broke the moving averages, like today, it lost 29% in one day. That's why you got to follow the charts. But further back, it started breaking down. So if you got out, you could get back in, but then you'd get back out again. You got to follow the rules, the moving averages, the relative strength. It will keep you from getting slaughtered like this stock is getting today.
Yep. And a few key points we've talked about many times on the show, Dan, Don, myself, Connor, Todd as well. The average true market leader, when it puts in a secular top, drops an average 72%. And if you measure from high to low to today, it's about 70% drop. It might have even tagged that 72% average drop. And that is something you don't want to get involved in. That's a lot of money going down the drain. And some key points, you can see that previous stage 4 downtrend before this big move. Often these big moves are ignited by an earnings surprise, a massive earnings surprise that really just invalidates most of the institution's models, and they have to quickly revise their estimates upward, and that's what causes the drift upward in this movement. And then eventually, once the move matures, and growth can't go on forever, it's just power law. You can't double a company in perpetuity. It's just nearly impossible because the law of large numbers catches up to you. Eventually, you can't sustain that growth any longer. You have this negative earnings report, and that's what caused ELF to trigger into a downtrend. And one more thing to note is that fundamentals look best near the top. Don, you can also highlight those earnings numbers on the bottom of your screen. There's many triple digits, high double digit earnings. And then once we're in a downtrend, already 50% lower, you start getting these negative earnings surprises, as you can see in the last 2 to 3 quarters. But at this point, if you're only selling on fundamentals, not looking at technicals, you're already down 70% from the all-time highs before you get out looking at a miss, which happened today, causing the stock to drop 26% in one day overnight. So the second stock I want to talk about, it's also in the consumer discretionary area, Abercrombie & Fitch. Like ELF, this was in a sustained linear downtrend. You can see the 30, 40 week moving averages were also sloping downward, and that's exactly when you want to be out of the stock. But at one point, just like when you start topping, a bottoming process can be identified when those longer term 30, 40 week moving averages see the slopes start flattening and turn up. And again, what triggered this move was that huge positive earnings quarter. Don, if you could highlight that first triple digit earnings quarter, like 7 quarters ago. Pretty much A&F, the story here was that they revamped their whole collection to kind of cater towards a wider audience, and that led to 5 to 7 beat and raise quarters. And that also led to 1,000% plus move. As you can see, once again, the 30-40 week moving averages caught up the price. Don, you can highlight that in this recent stage 3 top. Then we had this news failure 4 weeks ago where they raised guidance, and then the stock didn't go up. It actually triggered downward. And that's often a clear sell signal when you get good news, but the stock does the exact opposite. That's not when you should start buying the dip just because they raised guidance. If you look deeper into it, the market's expecting much more than what the company released. And you can see 200 days flattening and turning down. The 821 and 50 have crossed below the 200, and now you have bearish, full bearish alignment. This is exactly where you want to step aside and not be in the stock, or you can short as well. And the fundamentals actually here back it up too. They have deceleration in earnings and revenues as well. So there's this, and so far I believe this is down nearly 50% from the highs, if I'm doing my math right, if I see the numbers correctly. I see around 200, and it's about 100 now, so almost a 50% drop from highs to lows so far. And looking at the technicals, this looks like it's just the beginning of this downtrend as it broke some key support levels and price structure. A third example I'll quickly go over is FTAI. This also had an ELF, ANF type linear stage 2 uptrend. Just huge move as well. And just like both the prior stocks I showed, it built stage 3 top, then it had a negative news. I believe this one was catalyzed by a short report. It doesn't really matter what type of news. If the market reacts terribly on a piece of news, that shows you that institutions are flooding for the exits. So this broke into stage 4 as well. Those MAs are flattening and looking to align in a full bearish alignment.
Is that black the 50 day? Is that black the 50 day, or what is that black
40,
right there?
40 week moving average.
40. So would you short there? Would you short there if it rejects?
Yeah, this is actually so this is actually a decent place to start a short starter position. It's rejecting the 200-day moving average. I believe it's getting back below the 21 exponential moving average, and the 200-day also coincides with the 40-week as well. Just big area of resistance. And yeah, it looks like it recently retraced 50% of its downward move. Don highlighted the volume contraction, which shows that there are less buyers and sellers now. And yeah, this is a decent spot to start a short position, in my opinion. And then finally, a stock that everyone adores and loves and everyone talks about, where I'm starting to raise some flags, is the king, NVDA. Not saying the move is done. This could just be a huge base that continues upwards. But let's do the same analysis once again. Let's forget about the name of the company and what they do. Let's look at price. Once again on the weekly, Don, if you can go to that. Let's key in on the 30 and 40 week moving averages once again. In that inflation bear market, before this whole AI bull market, same thing, trending below a declining 10, 20, 30, 40 week moving average. Eventually those moving averages caught up to price. The slopes of the moving averages flattened and started turning up. And we had that catalyst where OpenAI released ChatGPT. The entire market realized that to train these models, we need enormous amounts of GPU and compute. And that's what started this 2-year bull market or bull run in NVIDIA with multiple 6+ beat and raise quarters, which is actually the average of a true market leader. And now recently, we've gapped down below the 30 and 40 week moving averages for the first time since the start of the move. That's a key character change that cannot be ignored. The RS line has failed to make a new high as well relative to price, which actually briefly made a new high. So that's a subtle sign that actually O'Neill talks about that can signal that a stock might be topping. And right now we're really at a key inflection point. If NVIDIA can reclaim the 30-40 week with power and volume, this might have a chance to go higher. But right now, the sell weekly candle last week was on massive volume so far. Volume is quite low relative to last week's volume. So just raising some flags here.
Yep, and
Obviously
price is truth.
No, it's over.
Price is truth, no exceptions.
There are some flags,
Yeah, listen, price is truth, no exceptions. Do not get married to a stock. You've got NVIDIA groupies, you
Yep.
got Tesla groupies, you got these people that they will fall in love with an idea. And look, we've got some people that work directly with Elon Musk. They're engineers, and they did really well with Tesla because they worked there. They got Tesla stock. If we had held their Tesla stock in 2022, they'd have lost 70% of their money. They'd have lost literally 2/3 their net worth. You cannot hold. And by the way, it's not just growth stocks, folks. It's not. Go look at GE, and GE's actually kind of looking decent now. But for years, it was a dog. Microsoft was a dog for 16 years. But even mundane dividend stocks, folks, during corrections or bear markets, they get slaughtered too. You got to have a sell discipline on every position. All right. Sorry, Ted.
Yeah. So just to wrap this up, I kind of sound like a broken record talking about each example, but it just shows that if there's any certainty in the markets in the world, it's everything moves in cycles. Everything is cyclical, and this is NVIDIA could play out like ELF, like ANF, like FTAI. We don't know for sure. What we do know is that fundamentals do look best at the top. NVIDIA has the technical signs that it might be rolling over as well. So we're monitoring this situation really carefully because NVIDIA is one of the biggest market cap companies in the world, and it's quite consequential for the price of the S&P and NASDAQ.
Yeah, the entire market.
Don, do you have anything to add?
No, great summary, Ted.
Good job, Ted.
All right, let's pass the baton over to Connor. Take it away, Connor.
Yep, I've got a kind of real life example of Ted's, Ted talking through, and it's going to be AMD. And this isn't cherry picked because this is an actual trade that I took last year, and I actually did a podcast segment on it like about a year ago as well. But if you go to the daily Don on AMD, and if you just change you can keep it in February, you just change the year to 2024. And so with AMD, this one was, I was super bullish on this stock. And as you can see, in the last podcast I talked, started accumulating it in 2023 and started adding to it in 2024 and held it for over 2 months. And right, like when you're looking at a trade, you want to be bullish on the story because that will allow you to hold through a pullback, not a correction, a pullback. And that's can make it easier when you understand the story, but we always sell on price. And as you can see, AMD during this period, it was one of the relative strength leaders in the semiconductor sector. Price was acting phenomenal. The story was there. And, if price is going up, there's no reason really not to be bullish on something. And it had a relative strength. So, in this time, there was really no red flags on AMD. And then if you bump it to April, this will show a better story of the chart. And see when that gets there. So, and then this had this final breakout over 200 and left that nasty bar. And during this time, I still owned it, was still bullish, and it pulled back to the 50-day. And that's what I was trailing with as I had more cushion. But right on that harsh break of the 50-day on volume, to me, that was a huge red flag. And after a powerful breakout, that shouldn't happen. And that was when, around that time, sold all of AMD, never touched it again. And if you go to current day now, the stock's down, over 50%. And I think the lesson here is, things can change quick. The market's quick, and you can't fall in love with the story. And, if you're someone that's still holding AMD, not only are you holding something that's going down, so you're basically holding a depreciating asset, and 2 is the opportunity cost. When AMD started to break down a month and a half prior, this is when NVIDIA kicked off, the second leg of the bull market. And that's when it had that massive breakout and trended for months on end. And relative strength was just another screaming signal that something's wrong with AMD, especially if the whole sector is going up and this one's going down. And ever since, it's been going down the whole time. It had earnings this week, gapped lower again. And for someone holding it with no rules, no sell discipline, no plan, not only is the opportunity cost killing you, but also it's doing nothing for your position. And that just goes to show you can't fall in love with the story and expect something just go up if the price isn't cooperating.
Great point
that's all I
to
got.
reinforce. Yeah, great point to reinforce. There are no hold forever stocks. What do you know what the news catalyst was this day when it had the big gap up, the last hurrah here, Connor? Apparently it wasn't earnings. Maybe it was NVIDIA's earnings or something like that it gapped up in sympathy with. I don't know, but you see a candle like this on something you're long against, and you break below the following day. I mean, that's an alarm bell. If you know what you're looking for in the market, if you're a technician, this just screamed sell. You could have held on and say, well, I'm going to give it to the 50-day, and it bounced a couple times at the 50-day before finally another big nail in the coffin bar did it in, and then tried to rally again a little bit. But it's very strange. I had high hopes for this one too, because the word was that they were number 2 to NVIDIA as far as chips for data centers, and it just hasn't played out that way. No earnings surprises whatsoever for them, and just a terrible stock. Like we said, all stocks are bad unless they're going up. Thanks, Connor. Let's pass it over to Todd.
All right. Wow, what an awesome segment. I think it's so important, and this might be one of the more valuable ones, just to really go back and look at how devastating those losses can be if you fall in love with a stock. I just don't know how anybody operates without charts and sell discipline. And speaking of that, I just want to talk about the aftermath of the DeepSeek sell-off that took place on the 27th. We started getting rumblings of it exactly 2 weeks ago today, and then obviously we had the weekend to really digest just how impactful the DeepSeek news was to the AI complex. And what I want to talk about, we already know that DeepSeek came out much cheaper, potentially, although there's a lot of doubt about the exact truth of the whole matter. But in general, it really turned the whole AI thesis on whether we need to be throwing as much horsepower in terms of processing power at the AI model, or whether it can be done a lot more efficiently. And we came in on Monday and we exercised our stops. And we didn't get stopped out of some names. And it provided a lot of valuable information. And I just kind of want to go through the winners and the losers of the DeepSeek disruption. Okay. And Ted already spoke about one of the potential canaries in the coal mine with NVIDIA. NVIDIA lost $600 billion in market cap on that day. Traded huge volume, and it's not been able to really recover. It broke the 200-day moving average, and it's having a hard time poking through. Now, it may do that, it may not, but in general, it's definitely showing up to be one of the losers, because we might not need, at least in the intermediate term, that much hardware and processing power to carry on the AI build out. Now, all the hyperscalers have come out with earnings. So far, they've all kept their budgets, and some have increased their budgets. So the spending plan is at least on track, if not more than what it was that they announced last quarter. But if we go through a couple of these losers, we're seeing that, a lot of these names may not be good. And another one is SMTC today, which, obviously the investors smelled something very bad out of the Amazon quarter. I don't know what the news is here, but here's another data center play that's been decimated. I'll do another name, MRVL, which I personally bought on Tuesday, but got stopped out today for about a 3.5% loss. So, although this doesn't look as bad as the previous two examples, you see a very bearish engulfing pattern, that rejected this move back above the 50-day, and now it's testing the 50-day again. So those are just a few examples and some real-time examples of what did not do well post the DeepSeek disruption. Now let's talk about a few names in our portfolio that really gave us good visceral feedback right away on this news. Let's start with Palantir. Okay, so Palantir on the 27th closed down 4%. Okay, not bad. So right away, while other names were down 10, 12, 15%, Palantir was able to hold. Okay, well, what really caught our eye is the next day, which we've been long this stock, so we're just managing the position. The next day it was up 6%. Okay, so right away, the following day we saw rotation into mostly software and internet content names. And look at what Palantir's done since then. So it bounced like a rubber ball, held its averages, and we just got a huge earnings gap on it the other day, which has had massive follow through. Okay, so clearly a beneficiary of the DeepSeek disruption, and they're going to benefit from not only their own platform, but the ability to process more information and provide, overall better service for much lower cost. The second name that we were able to immediately get positive feedback on is Reddit. So on the 27th, Reddit was down 0.86%. Okay, reversed right off a key average, closed positive, almost positive on the day, and the next day it followed up with a 7% gain and broke out to all-time highs. Okay, it doesn't get any better than that. That's immediate feedback, support on the day of the bad news. Reddit clearly capitalizing on the growing AI industry by licensing their vast content that's continuously generated by users. And here we are making new 52 weeks highs today on a down market. Okay. The third name that has shown strength that we've recently initiated is Snowflake. So Snowflake was actually up 0.8% on the 27th. Okay, no damage done there, and it was up 7.12% on the 28th. And it broke out of a cup base and closed right at the highs of the day on good volume. Okay, so it's pulled back a little bit since then, but if you really look at this overall chart, you had a huge monster gap up on earnings back in November, when it was up 674% above average daily volume and up 32% on the day. And then overall, the market just wasn't ready to let it go. It just built this nice 18% cut base, showed very positive relative strength on the DeepSeek day, and it's now building a nice cup with handle here. So those are just three examples of stocks that we were able to hold and or initiate post DeepSeek based on the behavior of the rotation out of some of the names that are being sold versus some of the names that held up very well during this whole process. And that's it.
Great summary, Todd. Separating the contenders from the pretenders is what the follow-up to that DeepSeek day did. And we noted that day and the day after in the videos that money was flowing into software. And a couple of those names that you mentioned are software related, and they've not only recovered any losses, if they even had losses, but continue to make new highs. So good stuff there. Dan, that's everything from the tech side. You can take us on home.
That was awesome, guys. So, folks, let me ask you a question. Do your advisors sound like these guys? Or are they asking for tea times? Are they just spreading you out in the pie charts or us portfolio? Folks, remember the sell side, Wall Street, okay, They are creating the ETFs. They also get to pick the stuff they're putting in the ETFs. And then they're creating the pie charts or us portfolios for you to take your money and spread that money across their real clients, the municipalities, the countries, the companies. So I ask you again, are you the widget? Are you the portfolio input? Are you part of the portfolio? Are you the product or the client? At Revere, we're a fiduciary. We don't do any of that nonsense, okay? And when we buy something, we buy it for us, for our families, for our parents, for our kids, at the exact same price, at the exact same timestamp. If you want your money to look like my money and Don's money, come join the Revere family. There are no conflicts of interest, and you'll never, ever get a pie charts or us portfolio at Revere. That's one thing I can promise you. Folks, if you please tell a friend, tell a neighbor. We don't advertise. It's all word of mouth, and we're growing like a weed. Just go up to revereasset.com. Up in the right-hand corner, there's a subscribe button. Just put their name and email address. This podcast will go directly in their inbox Saturday morning. Normally, we record it on Friday. They do a daily market insight. Every day the market's open. We're the most transparent advisor, not only in the country, on the planet that I'm aware of. We tell you every night what we're doing. I don't know of any advisor doing that. And if you go to YouTube and just type in Revere Asset, you'll get this podcast before the close on Friday. Our stock nerds, that's how they get our stuff. So there's two ways you can get our content. RevereAsset.com, we archive everything, or YouTube and just search Revere Asset. And you can always call me old school at 855 Real Wealth. Folks, we'll talk to you next week on your money, not their money, your money.
Because it's not how much you make in the market, it's how much of that you can keep.